Hello everyone, and welcome to this special analysis that will be focused on the silver market, because we think this will be a big opportunity. So I think you will like it. Before I start, I have to remind you that this video is not investment advice, and if I'm gonna speak about specific financial instruments like futures, options, ETFs and others, it's always just for educational purposes. Although this video will be focused on a single market, a single commodity, it will be quite complex. I will start with the reason why we like silver right now, because we think it is very cheap from the historical perspective compared to other commodities, so I will talk about that. Then I will take a look at the reasons for the recent sell-off and general weakness in precious metals, especially silver, and what it implies for the future. So I will also speak a bit about the current sentiment in the silver market. And then I will delve into the fundamental analysis of the silver market that will help us to estimate the low price, or how low the price of silver can fall, or if maybe we have already seen the low. So that will be interesting. And finally, I will show you a very simple yet powerful strategy that if someone followed through the history, it was impossible to lose money using this strategy. So I think it will be very interesting. So let's go on. There is a great chart, a great study on SpreadCharts that can confirm the cheapness of silver. So I have prepared this study. I call it the asset price distribution, because that's what it truly shows. And it is basically the histogram for the continuous contract for the simple price of a few major commodities. I told you that in our tutorial and elsewhere that this chart is most useful for mean reverting quantities like contango or some intermarket ratios. And the price of commodity definitely isn't mean reverting quantity. On the contrary, commodities tend to trend over the long term, and I think they will continue to trend as long as we have positive inflation. So the goal of this study is not to estimate some mean value, but to compare the degree of expensiveness or cheapness of these commodities. So let's start with crude oil. You can see that the current value is to the right side of this green area, so definitely above the 95th percentile. The same can be said about corn. You can see it's well above the 95th percentile, which is the right edge of this green area. And then we have copper. It is also in the white area to the right side of the green area. Here is gold, the same as before. And finally, here is silver. Out of these major commodities, silver is the only one that is currently in the green area between the 75th and the 95th percentile. Of course, you can pick different commodities, and I think with a few exceptions, it will look the same. The silver is simply cheap compared to other markets. Of course, you can dispute this study by pointing out the different periods on each of this chart. And that would be correct, because we have full history for nearly all the major commodities, but each commodity has started trading in a different point in the past. So for example, we have 39 years for WTI crude oil, but 63 years for copper and corn, and 48 years for for gold, and 59 years for silver. So that's true. So let's switch to the past 20 years so that we have the same period on all these charts. And you can see that the current value is still to the right side of the green area for crude oil and corn. In case of copper, it is in the green area, but close to the right side, to the 95th percentile. The similar situation is on gold. It is also in the green area, but close to the right edge. But in silver, we are close to the left edge of this right green area. So in other words, we are close to the 75th percentile. So even this study over the past 20 years confirms that silver is the cheapest commodity out of those 5 I have selected here. This also disproves the argument that silver looks cheap due to the event in 1980 when the Hunt brothers cornered the silver market and launched a speculative bubble in silver, which is something that did not happen in any other commodity back then. But you can see that even if you look at the past 20 years, the silver still looks to be very cheap compared to other commodities. And now let's take a look at the current price and the short-term history for silver. So I will pick a few charts that I have prepared for you. The first one is the simple price chart for silver. You can see that the price has been falling off a cliff recently. It is not surprising, as we alerted you back then that metals are overbought. We even told you that we expect silver to break below the recent lows, the lows of this consolidation, and create a low beneath and then move higher, which is something we are observing right now. So that played out really nicely. I also have the price of silver in euros, which is this second chart, and 2 other charts, but let's focus on the price first. While the sell-off was indeed significant, there was no panic low. It usually looks like a tall candle with a large wick. It would be something like we saw in spring 2020. You can see these tall candles, or even before that in 2017. Here, this is a good example: tall candle with a large wick. And we can even go into 2008, the last financial crisis, where there was a panic sell-off in silver. So these are good examples of a panic low, and that's something that hasn't happened yet. There is no reason why there must be a panic low. The price can just turn higher and never look back. But it would serve as a great confirmation that the low is truly in. Moreover, the sentiment is really pessimistic right now, which is something that we expected with the undercut of the previous lows. On the other hand, there is still a lot of talk about cup and handle on gold and bull flag on silver, and it would be really great if these discussions stop. And finally, the main reason and the catalyst for the sell-off on silver is the tightening by central banks around the world, led by the US Fed. and there is no sign of slowing down in this regard. So all these things have potential to push the price of silver even lower. So while the sentiment is definitely pessimistic right now, which is contrarian bullish, we may get a rally followed by another sell-off. But this is not something we would like to predict. I do not want to sound bearish, because we are not bearish. We were bearish back when the price was attacking $27. But we are definitely not bearish right now. We are bullish. This is also visible on the commitments of traders data, because especially when you look at the speculative net positions, we are approaching the zero level, which over the past 2 years was a reliable indicator for turnaround on the price of silver. So the question is if this will be similar to the intermediate lows over the past 2 years, or if we are about to witness something more dangerous, like we saw in the history before 2020, where the net positions dropped even into deeply negative territory. So I don't know what happens. The price is definitely low, the market is oversold, the sentiment is pessimistic. This is clearly bullish, but we cannot rule out one more like lower, which would perfectly align with potential panic low and even more pessimistic sentiment and so on. Despite the monetary tightening by the central banks, there is still a lot of talk about a pivot by the Fed when it will be forced to abandon hiking rates and turn dovish. And I think as long as these discussions are ongoing, it is unlikely that it will actually happen, because one goal of the Fed is to crush these asset bubbles and bring inflation lower, and this is connected with the expectations of people. So as long as this talk will continue, I think it's unlikely that the Fed will actually slow down. However, in the long term, I think they will be forced to abandon their hawkish rhetoric, simply because we are not in the 70s. Unlike 70s, right now there is a huge amount of debt, both on the personal, corporate and governmental level. And if you tighten the monetary conditions too much, all this debt would eventually implode, and that would crash the global economy into something resembling the Great Depression in the 30s. And I think this is quite unlikely. Much more likely resolution is through higher inflation, similar to the post-war inflation in the US that erased the debt back then. So I think that is still the more likely scenario. I just don't expect it will happen as soon as everyone expects. And once this inflationary scenario realizes, it will set the price of silver much, much higher, because as much as silver is sensitive to the liquidity and monetary conditions right now, and you can see that it is falling steeply, it is also sensitive in the other way. So when the real rates stay negative, the silver will be basically the only option for common people to protect themselves against this inflation, because it is much cheaper compared to gold. And there won't be much other options. Of course, you can say that some stocks, especially the value stocks, would also do great. That's true, but For most people, the stock market is too complicated, especially for people outside of the United States, and this is very much true, for example, in Europe. So people prefer something more simple, something they can touch, and this is silver, basically. So that's the bullish case for silver, in my opinion. And now let's move to the fundamental analysis of the silver market, because it will help us to estimate the low price of silver that's truly sustainable in the long term. I mean, the minimum price that's sustainable. And usually when people talk about the fundamental analysis, they focus on supply and demand. But I will do something different, because from my experience this doesn't work. That doesn't mean the supply and demand is irrelevant. Of course it's not. It's the main driver of the price of any commodity. But the point is, it's very hard to estimate the future supply and demand. And if you take a look back, for example, to the previous decade, there was a lot of bullshit, a lot of forecasts for demand for silver to explode and supply to shrink, and people expected the price of silver to skyrocket in 2012 and 2013 based on the supply and demand estimates, and they were proven wrong. And that's the reason why I do not try to play this game. Instead, I focus on something that is much more objective and easily predictable. And these are production costs of the primary silver miners. While the price can easily drop below the production costs in the short term, and it happened in the past, it is very, very unlikely for the price to stay low over the long term, to stay below the production cost. It's simply impossible, because sooner or later miners would be forced to curtail the production and reduce investments into future production, and that would shrink supply and bring the price into balance with the supply and demand. Now, I said that I focus on production costs of primary silver miners. But if you're familiar with the silver market, you know that the majority of silver is produced, is mined as a byproduct of gold mining or copper mining or, I don't know, zinc and lead mining. So the primary silver miners are responsible just for roughly 30% of silver mined overall. The reason I focus on these primary miners is that they publish the production costs related to silver, so it's very simple to analyze this data and get this data, and they are still responsible for a large chunk of the production, which means that if they would mine just 5% of the overall supply, they would be unimportant and their data would be unimportant. But like I said, they are responsible for 30% of the mining market, which means that if they are forced to reduce their investments and curtail the production, that would have an impact. And the market would not be able to work properly without these miners. So I compiled the production costs for the most important primary silver miners, and I will present the data to you right now. Before I start, I have to say that I tend to focus on the all-in sustaining costs, which includes investments to sustain the production and general expensive, and these costs are somewhat higher than the true cash cost that is necessary to actually mine the metal, but I consider these higher all-in sustaining costs to be more representative of the true production costs, because like I said, this is the price that is really needed in the long term to sustain the production. So let's start with Pan American Silver. And you can see that their guidance for 2022 regarding production costs is between $14.5 and $16. I mean the all-in sustaining costs. So that was Pan American Silver. Now, here is First Majestic, another well-known and important primary silver miner. And take a look at the right column. Once again, this is 2022 guidance, and you can see the average all-in sustaining costs between 15.18 and 16.35 US dollars. Here we have the well-known Hecla mining company. Take a look at this left picture and focus on the blue bars, because they show the all-in sustaining cost over the past few or several quarters, and you can see that the Hecla is really cheap. They can produce the silver very cheaply because their all-in sustaining costs are between $9 and $14, and for the past quarter their all-in sustaining costs were just $7.64. So this is very low number compared to other miners. Here is another company, and this is Endeavor Silver. And you can find the all-in sustaining costs in this row, and it is currently between $20 and $21. So it's closer to the top range compared to the other miners. So this is a rather more expensive miner. And here is the data for Fortuna silver mines. Once again, focus on the rightmost column. And they have their all-in sustaining costs for the mines in Mexico and Peru. For Mexico, it's between 13.7 and 16.1 US dollars, and for Peru, it's between 17.8 and 21.1 US dollars. And this is Hochschild Mining, if I'm not mistaken. And they have the all-in sustaining costs for 2020 that was at $12.8, and in 2021 it was $14.4 US dollars. So once again closer to the $15 level. And now this is important because this is data for Fresnillo, which is the largest silver mining company around the world. They produce roughly 50 million ounces of silver per year, so that's a lot. This is also the reason why I found out also some older reports, so that we can see how their production costs evolved over time. So this is the last data I was able to get that are valid for 2021 over the whole year. And for 2021 their all-in sustaining costs were $15.2 US dollars. Here we have the half-year results from 2021, and back then the production cost was $13.8, so it was quite cheaper, quite lower than at the end of 2021. So production costs went up. And I also have the data for the entire 2020, and you can see that the all-in sustaining costs back then were $12.4. So I think the trend here is pretty clear. The production costs increased over the past 2 years from $12.4 up to 15.2 US dollars. And once again, this is not just some small mining company. This is the largest mining company, silver mining company around the world. So I would say the message is pretty clear. On average, based on the data you just saw, the all-in sustaining costs for the majority of primary silver miners are somewhere between $15 and $20. Of course, there are some that are way below this range, some are also above this range, but in my opinion, this is the range, the average for majority of these miners. In other words, this is the buy zone, because if the price drops into this area or even below this area, it would not be sustainable in the long term for these companies to mine silver. Moreover, as you saw with Fresnillo, these costs are likely moving higher. And that's no surprise, because we all see that the price of diesel, which is a major item for these miners, is skyrocketing. The labor costs are increasing, the materials are increasing. So I think it's reasonable to expect this all-in sustaining costs to trend higher over this year and also in the near-term future. And finally, I will show you the simple yet incredibly powerful strategy. Someone who followed this strategy simply couldn't lose money over the past 20 years or maybe even before, despite its simplicity. So it is based on the gold-silver ratio, and once again, it's really simple. All you have to do is buy silver whenever the gold-silver ratio gets above 80 and start selling the silver when it drops below 50. Once again, that's all. It's that simple. You can check and compare the ratio to the price of silver, and you will see that it's been really working great over the past few decades. So that's it. That's the strategy. It's true that the ratio moved in slightly lower levels in the past. It will be visible on the distribution of the gold-silver ratio, because on the 20-year distribution you can truly see the cutoff on the left side below 50, and also on the right side below 50, and also the second cutoff is above 86. But when I zoom out and show you all the data, the 48 years of the data, you can see that in the past it was also common to see the ratio close to 30. On the right side, it didn't change much. The 80 level was is still significant, but the cutoff is more gradual. It is certainly possible for the ratio to drop to 30 if silver enters a bull market, but I would say that in modern times the 50 to 80 range is, or at least seems to be, valid. So if we look at the current value of the gold-silver ratio, you can see that it is way above 80, which is something we alerted you a few weeks ago. Specifically, we told you that we expect this consolidation to break higher, and our target was around 90, and the ratio turned lower somewhere around 88. But once again, we told you it would be area around 90, not precisely 90. But of course, it's still possible that we will reach or maybe even exceed the ratio, the 90 level, as I told you. Let's see what future brings for silver in the near term. But the point is that we are above 80 right now, which means that silver is really cheap, and investors into silver should already have a significant position in silver, because from the long-term perspective, this is a great buying opportunity, in our opinion. Of course, that doesn't mean to go all in, because the price of silver can still drop lower, as we told you. Moreover, I forgot to show you the seasonal chart, where you can see that we are in a period of unfavorable seasonality. May is not so bad, but June is once again not really good for silver. So maybe we will get a bounce followed by another sell-off into June. Who knows? But we would not be surprised by a drop below $20 into the buy zone from the fundamental perspective, as we have shown you today based on the production cost, because the area from 15 to 20 is the buy zone. So that would be even greater opportunity if something like that happens. But it's also important not to forget that from long-term perspective, it is a buying opportunity even right now, because of the gold-silver ratio that is above 80. I even highlighted two supports on the price chart that, in my opinion, will be important if the price breaks below $20. Once again, there is no guarantee it will happen. This is not something we would like to speculate on from the long-term perspective. So investors, this is not something that would be too important for investors, but it might be important for short-term traders. So these are two levels that I think are important. One is somewhere between $18 and $19. The second one is just below $16. We shall see what happens, but if the price breaks below $20, then at least the first level is very likely to happen, or the price is very likely to reach this level. So we shall see what happens. The sentiment is very pessimistic right now, which means there is a good chance for a bounce higher, which is something we are already observing right now. In the medium term, there can be another drop lower, but from the long term, we are bullish, and even the current price is great from the long-term perspective. And that's all. That's the conclusion of this video. I hope it will help you in some way or the other. We tried to give you a complex overview of the market from the fundamental to technical perspective, and also presented a very simple yet very powerful strategy that I think would work very well even in the future. So thank you for watching us, and see you next time.